Good evening, everybody. It's a nice spring evening here in Pittsburgh. 74 degrees tonight, and all the white trees are out. And we've got the great pleasure of having Stephen Place with us tonight. I say great pleasure because every time he shows us his information, it's very good, high-quality, logical stuff on good option trading strategies. So with that, Stephen, welcome to the Candlestick Forum. We're anxious to see your information tonight.
All right, thanks so much for having me. Good morning, good afternoon, and good evening, wherever you are in the world. My name is Stephen Place. I'm the founder and head trader over at investingwithoptions.com. Thank you so much for taking time out of your day to come watch this special presentation. Today, we're going to be talking about stop-loss profits. This is a specific set of trading strategies that I like to use. I call them SLP trades. And what I would like for you to get out of this is a different kind of mindset when it comes to looking at charts. I think that oftentimes when we start our careers with trading and investing and technical analysis, we look for holy grails and we look for patterns that are going to fit in our neat little boxes all the time, but the actual market is messy. It doesn't fit in a nice, neat box, and we can actually use that to our advantage. So quick disclaimer, we're going to talk about stock trading, we're going to talk about options trading. It has the power to change your life. Whether it changes it for the better or the worse, it's going to be up to you. How you manage your risk, how you size your positions, the kinds of trades you put on will all dictate whether or not you're going to be successful in the long term. I'm not your broker-dealer. Options, just like any other leverage instrument, you have the potential to lose all your capital in a single trade. Okay, so manage your risk, size appropriately, and we'll get. So today's plan, we're going to talk about three concepts. We're first going to identify the pain framework. And this is just the 20,000-foot view of how the SLP trades work. And we're going to look at key market patterns and how to identify them in candlesticks and how to identify them in chart patterns. And some simple risk management ideas, especially if you do like to trade calls and puts straight up. You can also apply these risk management techniques to straight stock only or other option spreads. So what I'd like to do really quick is see where you're coming in from. I know we do have a chat. Hopefully the chat is going to be active tonight. I'd like to have lots of questions, lots of feedback with what we're talking about tonight. So I'd like to see your city, state, country, planet, where you're coming in from, and it also helps me get an idea of how quickly we get feedback. So if questions come in, how fast do they come in? Michael coming in from Ottawa, JJ New Jersey, Bill Denver, a couple others from Denver, Jim Ohio, George Vegas, Dale Albuquerque, Jamal Webb Florida, Joel San Diego, J OH USA. My family is from Melrose. If you've never heard of Melrose, it's in Ohio, and it is northwest Ohio, and you'll probably never hear of it again. That's how small it is. Alan from Lubbock, Robert from Cool, California, Bobby from Utah, John from LA. A lot of people coming in. Great to see. We have a very, very active chat room. Thank you all so much. So we're going to take a framework that you've probably experienced. So I'm going to say, tell me if you've ever experienced this, but to be quite honest, you've experienced this. Everyone who has had any kind of experience in trading and investing, we've all been there. But we are going to take this framework and turn it on its head. So we take the pain and turn it into an advantage. So here's the basic idea. Here's how this works out. First, you have your Holy Grail setup, whatever it is. Maybe you trade breakouts, maybe you trade pullbacks, maybe you trade compression or parabolics or reversals or continuation. Normally this happens at the beginning of a trading career where you say, here is the setup that I like to trade, and it fits nice and neatly into a little box. So you get it, you enter, and managing your risk properly, you place your stop. Here's a problem we have. There are a lot of people now who have access to charts. There are a lot of people who use technical analysis, and there are a lot of people who place stops. There is a tendency for stop losses to congregate around certain areas. And these levels tend to act as magnets. So what happens here is that you place your stop, the stock moves against you, and you get stopped out. As soon as you get stopped out, the stock reverses higher past your entry and into your profit target. We've all been there. And it sucks, right? It's not fun to have that happen because it's not just losing financial capital, it's losing psychological capital as well because you feel dumb when it happens, right? And it's not necessarily that your setup was bad. It may be that the execution of the idea is just as important as the idea itself. So what we can do is turn this around on its head and say, all right, maybe we should stop looking for where to place our stop and start looking for where everyone else is going to place their stop. We'll look at some examples in just a second, but this is the basic idea on a very fancy hand-drawn chart. Let's just say, let me pull up my pen real quick. I have nice and blue. All right, let's just say you like to play pullback. So stock runs higher, the stock pulls back. You say, okay, this is a pretty good entry point. You know, it's pulling back. Let's just say there's a moving average right here. So, you know, you play that pullback into a moving average, and then the stock bounces a little bit. You start looking good. Your profit target's at the most recent swing high, so you're still waiting for that. But then something happens. It rolls over. You know, nothing happens right there. You've got to stop right underneath your entry point. And what happens here, right, is that you will see the stock blow through your stop loss, get you out of the trade, and then a reversal higher. All right, that's the kind of framework we're looking to play. Because we're no longer saying this technical pattern or this chart pattern is going to fit in a nice little box. The market has evolved a little bit. And there are a lot of people who now gun for those stops on the institutional side. Let's take a different kind of look, and we're going to, instead of a 20,000-foot view, we're going to look at a 20-millimeter view. And we're going to look at market microstructure. This is an example. I just took a screenshot of Apple, and this is a depth of market chart. It's not pure level 2, but it's close enough for what we need to talk about. So on the left side, you have the bid. And the right side, you have the ask. What will happen many times during the trading day is that if there is an institution that wants to accumulate shares, they will try and find a way to drop the bid out. So let's just say, for example, there's a key pivot level at 203 flat on Apple. And then maybe Apple trades down to about 203.15, 203.10. And what you'll see is that the liquidity right here just disappears. It just goes away. The rug gets pulled and a lot of stop losses get run. And then all of a sudden, you see this size come back in. Serious size. That's sweeping up all of these stop losses, and then the stock reverses. So it cracks 203, maybe runs to 202.85, and then gets back above 203 flat, and then it's just off to the races. That is an algorithmic stop running strategy, and it's used all the time. You'll see it a lot in the futures market, where let's just say there's a gap higher in the market, and you have a lot of people who start shorting looking for that half gap fill. And then they say, okay, I'll run a stop loss. Let's just say we're thinking about E-mini futures, run a stop loss 5 points higher. You'll find that the market will gun 5 points higher and then start running to that half gap fill. That's on a very, very short-term time frame. And that is what I call algorithmic stop hunting. We can be discretionary stop hunters. Instead of trying to make a brand new high-frequency trading strategy and trade on milliseconds, we can look and trade on 30-minute charts or trading on daily charts, knowing that there are going to be a lot of eyeballs on specific patterns, and we can use that to our advantage. Here's the basic stop-loss profit structure. And we're going to take a look at some charts in just a second. I'm going to show you some that have happened in the past recently. I'm going to show you some that have happened a long time ago to give you an example of what happens when this pattern fails. And we're going to look at some potential setups, things that haven't triggered yet. So step one, you identify key pivot level. And you say, okay, that's the level, and I have a very sneaking suspicion that there are going to be a lot of stop losses if that level is breached. Now, sometimes a level is breached, and let's just say we're thinking long here, and the level is breached, and then the stock just continues down. We don't want to anticipate we don't want to buy just underneath a bunch of stop losses. We want to wait for confirmation of the reversal. So step one, you have a breakdown underneath that stop loss level. And what we're going to do in this particular case, we're looking at a 30-minute chart. I like looking at 30-minute charts because of past conditioning with respect to how the market auctions, and if you've ever talked about auction market theory, you have time price opportunities and things like that. All right, so I like 30-minute charts for this particular example. It also means that you're not stuck in a lot of noise. So you see a breakdown underneath a stop loss level. The first thing you want to do is you want to identify the open of that breakdown bar. We want to identify the open of that breakdown bar. And then we want to see a 30-minute close above that level. So first, you wait for the stock to break down underneath the stop loss level. And then you identify the open of that breakdown bar on a 30-minute time frame. And then you wait for a 30-minute close back above that level. For managing your risk, there's a couple different ways to do it. This one's fairly aggressive. You simply say, all right, let's the most recent pivot low. Okay. Now, if you want to get super aggressive, you say the low of this breakdown bar. Sometimes there's going to be a little bit more of an auction to the downside before an attempted reversal. There's also another way, if you're trading more of a longer term basis, you take this distance and you double it, and that is a wider stop loss. That is if you want more wiggle room, or perhaps you're trading a little bit less of an aggressive strategy like credit spreads in the options market. All right, so we take that distance between the 30-minute open level and the most recent pivot low, and all we're doing here is just simple risk management and profit taking. If you see a move that is the same distance right here, you just take half off. All right, so that's the it's what if you've ever heard of the concept of R, you take half off at 1 R, because the R is the distance between your entry and your stop loss. All right, so a 1 R sell half will get you, in my opinion, a better expectancy over the long term. All right, are there any questions about this kind of setup? So the next question, I guess, is going to be, well, how do we identify these levels? How do we identify where these stop losses are going to get hit? All right. Alejandro is asking, only in 30-minute charts. You can technically do this shorter term. It just gets a little bit. One way I would look to use it, say or I have used it on say a 5-minute chart. You have a breakout, and this is an in-place stock that let's just say is breaking out on earnings, and then you start to see that consolidation into lunchtime. You'll normally have a failed breakdown underneath, basically flushing stops. If you see it reverse above that, that's high odds of trend continuation going into the afternoon. So on, let's just say a 5-minute chart, you have the first hour trading. That tends to be a strong auction higher. As liquidity dries up as it heads into lunch, you'll normally see that swift move towards the end of lunchtime. That tends to lead to a continuation higher into the afternoon session. And if you remind me towards the end, I'll try and hunt down one. I think one happened on Qualcomm today. Okay. BM's asking, does it work on daily charts? Yes. We're going to look at some daily setups and identify some candlesticks that you can use. You don't have to. Sometimes you miss the setup, but sometimes stocks go up and down, and sometimes you can still get decent entries with this. So where are some SLP levels found? The simplest ones are where we have, they're called CO levels for me. So what does CO stand for? Captain Obvious. Right? Captain Obvious levels, where everyone and their mother is watching this level. Everyone and their mother is watching this level. Those levels tend to be where a rookie mistake is to put a stop loss right at that level, right? Because odds are, at some point, that level is going to get gunned. So a good way to define a Captain Obvious pivot level is daily highs or lows that haven't been touched in 10 trading days. All right, so about 2 weeks. And then I also really enjoy using it with major moving averages. Because what's kind of a rookie stop loss level? Oh, if it loses the 20-day moving average, then I'll get stopped out. Well, guess what happens, right? Let's just say a stock auctions, it pulls back, it chops around, and let's just say you've got the 20-day moving average right here. Many times what happens is you'll see a knife underneath that 20-day moving average and then a reversal in the same day. That entry point is a good entry point. It's a really good entry point. Same kind of thing happens on a 50 and 200-day moving average. Now, Joe just made a great comment in the chat. Said this is similar to a double top or double bottom or a MACD bullish divergence or bearish divergence. You can also put the same kind of concept with an RSI divergence. All right, so let's say, for example, I'm going to keep drawing right here. Let's say a stock is sold off and it bounced, right, and then it chops around. What happens here? Oftentimes, the stock will make a lower low with a momentum divergence, either a MACD or an RSI, however you want to do it, and then it reverses back higher. All right, so that concept applies here because you'll have the early dip buyers who will use that most recent pivot low as a stop loss level, and then the stock will break underneath it, have a momentum divergence, and if buyers show up, that tends to mark an intermediate term bottom. Michael's also making a great point. Even numbers. Yeah, so a stock is trading at 105, you buy it at 105 and say, oh, if it loses 100, then I'll get out. Right? Those even numbers, those whole numbers tend to act not only as stop loss levels, but also as magnets. All right? So do you see how this approach allows you to view charts in a different way? We're now not just focusing on patterns. We're now focusing on what are the motivations of other market participants, and can I take advantage of it? So here's some daily candlesticks, because we talked about a 30-day chart. We can also identify this using daily candlesticks if you do want to trade this on a longer-term basis. First one, pretty obvious, is a hammer candlestick, right? You don't just think about, oh, here's what it looks like. Think about the concept underneath. Think about the concept underneath a hammer candlestick. What does this actually mean? You have this wick right here. That means that there was an auction lower at some point during the day, and that auction lower failed, and there were enough buyers generated to jam the stock higher. That is how a hammer candlestick is generated. It is a representation of a failed auction lower. And if that failed auction coincides with a key SLP level, then you have a case for a very good swing low. Another one that I really like is a piercing pattern. Now, this one I just put the whole bodies in. I didn't, deal with wicks or anything like that. But the concept is another kind of failed auction. It's another kind of failed auction. Think about what happens. You have an ugly sell-off to the downside. The next day, the stock gaps down, but it fails to see follow-through to the downside, and then it rips higher, meaning that the aggressive buyers have showed up, and it tends to be a strong reversal level on the short term. If that coincides, again, with an SLP, then it reinforces the setup. Okay? There is a concept of patterns, of trading patterns in technical analysis. And way too many traders focus on pattern fulfillment. I'm here to make the claim that pattern failure will give you better setups many times than seeing a pattern fulfilled. Right? Especially when it comes to, the textbook patterns. Right? You see that pullback into a moving average, many times it's messy. Many times the stock will just jam down past that moving average, then reverse higher. Here's another example. This is a recent one. This is in the NASDAQ, in the Qs. And I'm going to change my ink color so you can see this. Island reversals and abandoned babies will often be great reversal points in a stock or market. So here was one. I mean, this is, if there's any kind of textbook setup for it, this is it. An island reversal is where you see a gap higher and then a gap lower on non-consecutive days. That's the basic idea. So in the Qs, we had this pivot level right here. It was all-time highs. And then the NASDAQ gapped higher, and it broke out. And then in 6 days, it gapped down back underneath it. Many times when we see this failed break, it leads to an auction back to the lower end of the range, which is exactly what happened right here. So abandoned babies are a different kind of candlestick pattern where it's, instead of non-consecutive days, it's just a single day. So a gap higher and then a gap lower. All right, that's the kind of reversal we'd be looking at. Okay. Raymond's asking, what's SLP? SLP is stop loss profits. That's what we're talking about here. We're basically looking to identify failed auctions around key stop loss levels. We're looking for the market to run and gun easy stop loss levels and allow us to find really, really nice reversals. Now, Michael's asking, we're thinking about concepts where stop loss levels are. What about option strikes with large open interest and volume? Michael, in my opinion, that used to work. It doesn't anymore because the concept is option pinning. With the introduction of weekly options and with the introduction of many, many more strike prices, I don't think that has as much efficacy anymore as it used to. Now, there's some more advanced stuff when we think about short gamma and things like that, but that's kind of beyond the scope. That's a little bit more of the dark magic of options trading than what I want to get into today. Okay. Bathwater gaps are another really good example of this. This is a recent example in Apple. And Apple, you know, with all the other FANG stocks into the fourth quarter of 2018, just took a giant dump, right? Down something like 30%. It was trading at like $200 a month or two before this, and then it sold off, and then traded down to 155. Now what happened with this gap is the company threw the baby out with the bathwater. And they said, okay, we're going to guide down on earnings, sales are going to be light, and our fundamentals are kind of sucking right now. What tends to happen when a stock is seeing aggressive selling and then it sees a large gap in response to fundamental news, that fundamental news tends to get priced in. So this is an alignment with, this is aligned with fundamentals of the underlying company along with technical analysis. You'll also see this sometimes. It doesn't happen as much to the upside because positive earnings tends to bring positive earnings growth. But let's just say a stock breaks out on earnings and then an analyst upgrade comes out and you see a gap, that tends to be a potential failure point to the upside. This is more of an exhaustion gap to the downside. I like to call it bathwater gaps because they're normally coincident with some kind of really bad news out of the company. If that level holds, then that tends to mark an intermediate term bottom. Okay? So let's take a look at some recent examples. Let's take a look at some key levels that were way too obvious that got run and led to sharp reversals in individual stocks. So the first one, the most recent one, is Amazon. So Amazon, like all the other FANG stocks, took a dump in the fourth quarter of 2018 and started to recover, and then it got into this trading range. And it had earnings, and it was at the top of this trading range, and then it started to sell off. Now, just look at this chart. Here's a pivot level, and here's a pivot level, right around 1580. What happens here? We see a break underneath 1580. We see a hammer candlestick get built out, and then a move back into the range. When you see that kind of SLP setup with a failed breakdown, there is a tendency for the stock to auction to the other end of this range. And that's what happened. And then once it hit resistance, it actually came back and retested that SLP level again and held, and then the stock jammed to 1800. All right, that's the kind of concept we're working with here. Excuse me. Now here's another setup. This one hasn't happened yet. This is one I'm stalking, and actually what I'm going to do really quick, I'm going to try and pull up some charts. All right. We'll just pull over to TradingView because there was one that I just remembered off the top of my head. I'm going to try and hunt it down. And because I want to kind of show you the origin story of how this played out. Okay. We'll get that set up in just a second. Here's an example of Marvel. Now, this stock has run from $20 to $25, so it's about a 20% price appreciation over the course of maybe 2 or 3 weeks. It's parabolic right now. And we have this key price level from today's trading. Now, I don't actually know how the stock ended up at the end of the day because this is just on my scans. You know, it might completely just fall out of bed right here. Who knows? But what I would look for is a breakout above 25.5 and then an immediate failure, and that will allow a good parabolic short setup in the stock. Because once it loses that pivot level, it signifies exhaustion in the stock. Okay? What I want to do really quick, I'm going to ad-lib this a little bit, is we're going to pull up the chart of the SPY on a daily. And I'd like to bring your attention, because this is where the whole origin started for me. Back in 2009, right? So we're still hungover from the credit crisis. And this level right here was one I got caught on the wrong side of. Because look at this. This looks like a head and shoulders top. The market breaks down under $88 a share. And what happens? Nothing, right? It reverses, and then it just jams higher. Fast forward to 2010, we get the flash crash, and we have the same kind of setup. All these pivot levels getting hit. What happens in July 2010? If you don't remember, July 2010, there's a Eurozone crisis going on yet again. Well, what happens? Right? You see this failed breakdown on a weekly chart. A lot of stop losses get hit because there's a lot of key pivot levels at 104. All those levels get hit, and then there's a reversal back to the other end of the range. That kind of setup is exactly what I'm talking about right here. Here's an example, and this one I am considering headed into Friday, so tomorrow. This is in Netflix. Now, Netflix has done nothing for the past 2 months. And there's a setup in conjunction with this that I call a compression breakout. Basically, we're looking for volatility compression and lack of movement and lack of trend because the odds of trend coming in are high. Now we have this abandoned baby right here. That this pivot level, we saw a breakdown underneath it and then a reversal higher. Okay, so that's the first level I'm looking at. And then we have this second pivot level, followed by a hammer candlestick and a reversal. This was coincident with the news that Disney's going to do their own streaming service. So there was bad fundamental news for Netflix coupled with this price action, and yet there's a failure to see any kind of follow-through whatsoever. These stop losses just keep getting run. So any investors who have been trying to hold this stock over the past 2 months are getting exhausted right now, psychologically, because the stock hasn't moved, and yet anytime the stock sees a stop run, there are institutional players underneath the surface that keep snapping up these shares. It's evident in the candlesticks. Now, what's not shown on this chart is, well, it is, but the price action isn't shown. This red bar is where the stock traded into after earnings. So there is, underneath the surface, this massive wick where the stock sold off very aggressively, and almost immediately those shares were snapped up. So you have three opportunities for the market to get taken out on Netflix. 3 opportunities to see some proper follow-through to the downside. In those 3 instances, at different price levels, there are institutions snapping up those shares. So we've got a good opportunity, I think, for a play in Netflix where, let's just say off the top of my head, something like the May 380-400 call spread, where it keeps your risk low and the potential for profit very high. Right? That kind of idea, that kind of framework is what I'm trying to introduce to you tonight. Here's another one. This is in data. I've been watching this one for a month now. All right, the stock, this is in the software as a service space. It was one of the leaders that kind of took us out from the depths in Q4 2018. It did make new highs right here, but failed to hold them. I've been looking for a move sub 120 for a couple weeks now, not as a way to short, but as an opportunity to get long. Now we have this. We have a combination of these Captain Obvious pivot levels that got breached today, as well as the 200-day moving average that got breached today, and yet the buyers came in force. So now we have a good low-risk opportunity against today's lows to say, hey, you know what? The auction lower failed. It might break down again, but that's why we have our risk limits. But the initial stops, the easy stops, already got flushed out of the market. And new buyers who bought sub 120 are now in a position of strength. And now you have the opportunity to play for a push to maybe 132. The only risk here is earnings is coming up. But that kind of structure works out incredibly well. Okay. And this is a 30-minute chart on data. So we have our breakdown bar right here. And we've now identified that level at 121. We want to see a 30-minute close above that level. If that level gets taken out to the upside, the setup is to buy the stock and run a stop underneath the new pivot lows after all the stop losses have gotten washed out. Now, you can look at this and say, well, data is trading at it trades at 121. Stop loss at 114 is $6 a share. That's a pretty wide stop. That's where options come into play, and you can look at structuring your risk a little bit differently. Maybe looking at call spreads or just looking at call buys straight up. Any questions about these kinds of setups? Debbie's asking a call credit spread. I'm assuming that's related to Amazon, and no, we would be looking at, call credit spread on Netflix. No, it's a call debit spread. So this would be a bullish trade, buying the 380 call and then selling the 400 call. The reason I like that trade setup is because 380 coincides with the most recent range high. So it's anticipating a breakout and then an eventual push to 400. Okay, that kind of structure I think works out really well. I did something similar in Amazon, which led to a $4,000 trade, where an entry point was right around here, right around this level. The trade setup was the 1700, 1750 call spread. 1700 coincided with the range highs, 1750 just a little bit above that. And then I scaled out of some and did some other things that helped to cut my risk down. And you can do that really well. You know, we're getting into some options, dark magic again, just because I like to talk about it. But if you pick up a bull call spread, a call debit spread with pretty wide strikes, and then it works out in your favor, you just roll up the long strike and it cuts your risk in half or by 2/3. Okay. With so SP is asking, so for data, do you need to see a break above the level? Yeah, I'm looking for confirmation here. I'm looking for 30-minute close confirmation. I may not take it simply because earnings are coming up. All right, so that's, you've got fundamental risk now instead of just straight technical risk. This is, in my opinion, one of the better examples I could show you in the market right now, and that's why we're looking at it. But yeah, you would need to see a 30-minute close above 121. You run a stop underneath that breakdown bar low, and you look for a push to range highs. Now, because the stop is so wide, there's some other execution techniques you can do and, scale in. Say, all right, I'm going to go half size here at 121, and then if it manages to see some sellers coming in again, I add. Normally, if I scale in like that, it's obviously just going to rocket ship higher, and I should have gone full size. Right? That's Murphy's Law with these kinds of things. Now, we've stepped through how these work. You can look at the other side of this setup too and say, well, if this doesn't hold, it's going to hit the fan. Most recent example, this is Q4 2018. This is in the S&P 500. All right, so we're looking at the spiders. For about 2 months, the market traded within a range between 2,800 and 2,600. Here's the first pivot level. Here's the second pivot level. See what happens right here? I'm pretty sure this is October. See that candlestick, how it was a failed auction lower underneath 2600? Do you see how it only held for 3 or 4 trading days and then broke underneath it? This is a very good momentum short opportunity where you have this setup, and if the SLP setup fails, it is often a very good momentum short opportunity. Alan, I've got your question. I'll take a look in just a second. Here's another example. This is, 2012, I'm pretty sure. Fiscal Cliff Voodoo was 2012. First pivot level, second pivot level. Market takes a huge dive and gets oversold and puts in the most textbook example of this. Hammer candlestick, failed auction lower, finished at highs. What happens the next day? We see a gap down and a loss of that level. That is a very good momentum short to take because it shows us that a bounce from oversold conditions didn't work, so we become more oversold. So Alan's asking, what about an SLP setup using a simple moving average? Well, data. Data is the best example I have on these slides right now. Here's the 200-day moving average. Right? If you're a trader and you bought data any time within the past 3 months, where are you going to place your stop? You'd be like, oh, I'll wait for a break of the most recent range lows, or I'll wait for a break of the 200-day moving average. Well, that happened. It caught a lot of people, got a lot of people stopped out, and yet there is a very fast sweep back above that. Just by eyeballing this chart, here's another example with the 50-day moving average, right? That kind of idea works, all right? So it's not just saying, oh, buy a pullback into the 20-day moving average. We want to say, as the stock heads into the 20-day moving average, we want to see these stop losses get hit and a swift reversal back above it. That's the kind of setup we're looking for. Any more questions on this setup? And it's not just a setup, it's a way of thinking about the market. We're not just looking at squiggly lines on a chart. We're looking at the underlying auction that the squiggly lines represent. And we ask ourselves, what are other market participants doing? What are their motivations? And where will they get screwed? And if we can identify where the majority of market participants get screwed, then we're going to do really well. Right? And that includes, if you just want to trade straight up breakouts, momentum breakouts are the fear of missing out, and it represents investors' anxiety of not getting on the boat fast enough, and that kind of upside momentum, that kind of idea, it's no longer just buying a stock as it hits 52-week highs because it's hitting 52-week highs. We're buying the stock because we expect other investors to start feeling investor anxiety of missing out. Tom's asking, why is the chart date 5/2/19? So what happens here? He's looking at this date. Wherever my crosshairs end up on the chart, that is where the date is. All right, so this is not an old chart. It's just that's just how the software works. So today's date, 4/18/19, is the most recent candlestick. All right, so Jim's asking, can you take a look at Lebu? So Lebu, for those who don't know, is a leveraged biotech ETF. Now, we're not going to look at this because it's leveraged, and charts on leveraged stocks, it's easier to look at the underlying, right? I would rather look at the underlying instead of, because leveraged ETFs are like options. I'm not going to chart an option. I'm going to chart the underlying of the option. Now, so IBB, for example, well, what have we got? Right, we've got a couple different pivot levels. The first one at 105 flat, and we haven't seen a reversal yet. We haven't seen a confirmation back above that 10. Was it really 105? It's about 105. Now, if we want to take a look at this on the 30-minute chart, the problem with trying to do this setup straight up is that the breakdown bar is all the way at 110. So for that to change, you would either need to go to a shorter term time frame, say a 5-minute chart, and really start looking for long entries, or do something else. Now, I can tell you right now that the move in the morning from today, where the ETF jammed into 106 and then failed, and we saw a hit to the downside, that's showing us confirmation of that level holding. We're not seeing an aggressive reversal into that point. Now, if, for example, we just see a straight shot and a close above 106 tomorrow, then you can make the case and say, all right, that's a pretty obvious failed breakdown, and we're due for a move to 115. All right. Here's another example. Recently, this was back from September, where IBB had this pivot high from the end of August, and it made a new higher high, but immediately failed, and the ETF finished at the low. All right, that was just kind of a classic double top with a twist, where we're not looking for an exact double top. We're looking for that new marginal high that fails miserably. And Joe's saying the market's closed tomorrow. Joe, you're absolutely right, because I had, I always think it's open on Fridays. CK is asking about CHKP. We can look at a couple more examples. So you could make the case, and this is kind of stretching it because I'm assuming this is related to earnings. The magnitude of this gap tells me that there was something else up, but here's a pivot level from March, and if we keep that lined up, and you say, all right, here's that pivot level coming into play. The stock opened at 120 and a quarter, broke down underneath that, so if you see a 30-minute close back above 120 and a quarter, you can potentially play the gap fill, because a lot of stops got run, and as long as those levels hold, and as long as you see confirmed reversal, then you've got a pretty good risk-reward opportunity, a pretty decent shot. That level just so happens to coincide with some previous pivot levels as well. Okay, so that can potentially work. This one's not as clean cut because I'm assuming that gap down was earnings, right? Yeah, or some other fundamental driver that led it lower. All right, so tonight we talked about how there is a way to analyze the market that's beyond just looking at lines on a chart. It's understanding the motivations of individual market participants or the collective of market participants, identify where those pain points are, where they get screwed, where they get stopped out, and look for a confirmation of the reversal. We looked at key market patterns with respect to candlesticks. We looked at hammer candlesticks, abandoned babies, island reversals, overshoots, things like that, and some simple risk management when we can look at a 30-minute chart, look for those key reversal levels where you can place your stops at the most new recent pivot level and trail your stop or put an initial profit target at 1R. All right, so what I'm saying here is that there are ways that you can get beyond the textbook setups and into how the market actually trades. Because there is a difference with saying, oh, here's a bull flag pattern, you just got to wait for a break to new highs, to understanding that it's really messy out there. And a lot can change and a lot of different things can happen. And having an approach, a strategic approach to the market, coupled with your analysis is what's going to get you an edge. So what I'd like to introduce for you tonight is a course that I have called Swing Trade Secrets, and it has my 7 favorite option trading setups for new traders. So we talk about compression breakouts, we talk about reversal patterns, we talk about parabolics and some other cool things you can do in volatility markets. Trading these 7, and they're all flavors of a different, sometimes you will have 1 or 2 setups coinciding at the same time to reinforce one another, but these 7 setups are, in my opinion, the best way to trade directionally. Each setup coincides with an option trading strategy. So if we're looking at pullback trades into a moving average, we're going to be looking at bull put spreads. If we're looking at compression breakouts, we're going to be looking at call buys. And having a strategy aligned with the technical analysis will help to stack your edge. So you'll learn how to identify SLP patterns in a stock, like we just did tonight. You get 4 major secrets that help to provide a framework for stock price movement. You'll learn about magnet levels, and we briefly touched on that tonight, where, if a stock is trading at $95 and it's at $100, it's just above it, hasn't been touched yet, odds are it will roll up into 100. If there's a very, very obvious resistance level, the market will tend to auction into that resistance level. So you can take advantage of that and anticipate before the breakout actually happens. You also get quantitative studies and scans, so you can quickly find all of these stocks, and so you can find the best stocks to trade, and you also get the best option strategy for each setup. And there's a lot more involved with the Swing Trade Secrets course. Now, listed on my site, it's $149. We're not going to do that tonight. We're also going to get you some special bonuses for class attendees if you watch this live or recording. The first thing you'll get is Mastering Your Mind, and this is all about option trading psychology. If you've ever heard about anchoring bias or prospect theory, there's some other things related to behavioral economics that directly apply to stock trading. There are some other things that directly apply to options trading, and if you can master those, you will help to avoid those disastrous losses that you'll often see in options trading. You also get Foolproof Option Buying, and this is an ebook that talks about how to systematically manage your risk when buying calls and puts. I briefly touched on the concept of R and risk multiples, and I go a little bit more into that in the training in Foolproof Option Buying. And you also get the Turning Point Indicator. This is my own custom study that looks at how fast individual stocks have moved and whether or not they're truly overbought or not. And I think that's a very, very useful tool. So to get access to this, we're going to take $52 off of it. So instead of $149, it's going to be $97. You can go to investingwithoptions.com/secrets to get access to the course. Okay. So if all this did was get you one good trade, would it be worth it? One good trade strategy out of this, instead of 7, maybe you drill down into 1, you get really good at it. That's going to be worth a lot of money over the long term. What if it helped you pick the best option spread, which it does? It allows you to be more consistent across different stocks and different asset classes. What if it keeps you out of the worst parts of the market and keeps you out of the worst parts of your mind with the Mastermind ebook training? I definitely think it would be worth it. So to get started, you're going to get all of that for just $97. The link is investingwithoptions.com/secrets. That will redirect you to a secure order form where you can enter your name and email and information, payment information, and we'll get that sent to you right away. So John's asking, are you looking for pivots that occur without a corresponding event? So it depends. When we're looking at CHKP, for example, I tend to not fade the first day after an earnings event or a catalyst. Now, if, for example, Checkpoint were in a very aggressive downtrend and then it saw a gap down in response to earnings, it's probably all the bad news is priced in, most likely. And if it put in this kind of hammer candlestick, that would be a little bit better of a pivot low. All right. So It just, the liquidity characteristics of a stock change over an event, and so that kind of changes it a little bit. Okay. Let's take a look at CARA. So Cara Therapeutics, because it's a biotech, I don't know if it has an FDA event up. You know, just keep that in mind. But yes, this would be a really good example where it's got a combination of a gap fill pattern as well as the most recent range lows. So this is a really good example. The events notwithstanding, right? But this would be a good example that shows you how the market failed to hold its auction lower underneath $18 a share, reverse back above it, and now you've got a pretty decent pivot level against those lows. Rob's asking, what are your rules going into earnings? You know, it depends. And I know that sounds like a cop-out. I don't like to initiate positions right into an earnings event. I think earnings trades are their own special breed. And I do have a course directly related to trading those. That one's a little bit more advanced. But when it comes to earnings, there's one really interesting thing when, for example, Netflix, and I don't have the IV charts right now, but after an earnings event, if the stock hasn't moved yet, option premiums tend to get really, really cheap, and so it becomes a better alternative to be a net option buyer. There's also some things that you can do looking for technical patterns in anticipation of an earnings event where you look for pre-earnings momentum. It's kind of beyond the scope of what we talked about, but there are pre-earnings and post-earnings strategies as well. All right, if Jay's saying the page redirected to Swing Trade Secrets for $49, so you guys actually may get a further discount because I will need to update the order form. Let's see. Yeah, it says $49. So instead of $97, you're getting it for $49, and that price is definitely not going to last because that is actually a legitimate pricing mistake. So I'm not going to change it yet because the order form's already up. But after Easter, I'm going to change it back to $149. All right. So instead of $50 off, you're getting $100 off. So yeah, my mistake is we just talked about taking advantage of other people's mistakes in the stock market, and now you're taking advantage of one of mine. So, yeah. All right, VL said, you mentioned Qualcomm earlier. All right, so what tends to happen when you have a stock that's in play? Now, Qualcomm had news related to Apple, and they're not going to litigate anymore, and so the stock jammed from 57 all the way up to 82. Now, what will tend to happen in-play stocks, not necessarily on the first day, but the second day, is that there will be towards the second. I divide the trading day into thirds. You got the morning, the lunchtime, and the afternoon, right? As we head into after the first 90 minutes of trade, sometimes there's a little bit of a shakeout. Qualcomm really doesn't have that characteristic other than this little bitty shakeout into 10:30. Excuse me, but we can, that's just an example I thought maybe would have worked. All right, so, you can often see that in just. I'm trying to think of any stocks that move big. I know we're out of time. Any stocks that have moved big to the upside recently on earnings, if you go and you look at a 5-minute chart, you'll see that first impulse higher, a sideways range, a stop run, because anybody who chased that first range higher gets stopped out, and then a secondary afternoon, or a secondary run into the afternoon. That kind of setup often manifests itself in in-play stocks. So here's an example in, what is this? I want to say Dallas Airlines. That's not right. Delta. The pattern's not showing. A second day play right here, you could maybe make the case for it where into the 3rd of April, it saw support hold at 56.5, and then the next day, let's see if I can highlight this. The next day right here, you had a break sub 56.5, but it didn't hold, and that could lead to continuation. Okay. Michael's asking, what platforms does your Turning Point run on? It's on Thinkorswim and TradingView and MetaTrader 5. We've been trying to add it to MetaTrader 4, but it just hasn't happened yet. Debbie's asking, are we going to get the swing trading course? Yeah, it's a recorded session. It's getting a reboot, and it's getting a reboot this weekend where we're getting the version 2.0 course out. But the 1.0 course is great. You're just going to get both versions, and you're going to get really good pricing, and you're also going to access to the lifetime upgrades as well. Alan's asking what software to use. I like TradingView, and I use Thinkorswim for analytics and executions. Okay. Any other questions? I know we're out of time. Debbie's saying, awesome, I'm in. That's great. One more thing. This is my email if you have any other questions. I haven't checked my email in like 2 weeks, so I got to get it cleared out this weekend. And if you email me with any questions, you'll be at the top of the list. Again, you can go to investingwithoptions.com/secrets to get access to the course, as well as all the other bonuses. We'll email the course to you today and the bonuses to you tomorrow. And then you'll get access to the course portal, so you can also see all the other courses that we offer at Investing with Options. Neil's asking, should we wait until after Easter on purchase? If you want to pay higher prices, you can. This was not a gimmick. It's the wrong order form and it's not the right pricing. So you will actually take advantage of my mistake. So you can get it at even a better price than what I was offering it to you today. So you can get it now, and you get all those bonuses now as well. If you wait after Easter, it's going to be at a higher price. So there we go. Any other questions with this? This presentation is something that I love talking about, and I don't get the opportunity to talk about it very often. So I was really excited to have the opportunity to come and speak with you all. Hopefully, the goal here is to open your mind to a new approach to trading the markets and understanding how the markets operate underneath the surface. And I hope you all got a lot out of it. George is asking, can you list the package again on the slide? You get the Swing Trade Secrets course, the Master Your Mind ebook, the Foolproof Option Buying, and the TPI indicator, all for, it's not $97, it's $49. All right, good deal. This is lifetime access. You'll also get access to all the other course upgrades. All right. Michael's asking, can you show the TPI? Yeah, we'll pull it up really quick. And you can get it on TradingView if you just want to pick this up on its own. It's got its own training. Whoops, that isn't it. There it is. All right, we want that one. And here we go. So the way the turning point indicator works is it basically gives you context. And it says, all right, how fast has the underlying stock moved and how has that worked in the past? So, for example, Delta Airlines, and this is a 7-day TPI, Delta Airlines moved 16% over a 7-day period, and that's well past the normal bounds. Now, that makes sense because it had earnings. But this allows you, this works especially well because of if you trade credit spreads or if you trade options, it helps you figure out strike selection a little bit better and say, okay, I'm going to buy this stock, I'm going to sell some put spreads, what's a good strike price to choose? And then you can go back and you say, okay, over a 30-day period, the stock is sold off at most 5%, so I'm going to choose strike prices that are 5% out of the money. It's a really good approach, and it gives you some context. Alejandro's asking, do you always buy, sell, looking for confirmation in 30-minute charts? This comes down to the duration of price acceptance and rejection. If the longer, let's say a stock breaks down underneath the key stop loss level, the longer it stays underneath it, the higher the odds you're going to see continuation to the downside. So that's why I'm looking at 30-minute charts, because you want to see very, very aggressive price rejection and a strong reversal. So you don't want to wait for 2 weeks, because if, let's just say, a stock breaks down underneath $100 a share and you're looking for a hard reversal, the longer it stays underneath it, the higher the odds of continuation to the downside. Okay? So that's it for me. Thank you all for coming out. Just really quick. There we go. Investingwithoptions.com/secrets. I'm going to turn it over to Steve, and that's going to be it for me. Thank you all so much for coming. Have a great night.
Steve, thank you very much. Good information. Everybody take a look at it. For the price, you're going to get way more than your money's worth. So with that, everybody have a good weekend, a safe weekend. We'll see you all bright and early on Monday morning.